Randall Kroszner joins us right now. I don't know if he's a coffee drinker, but I know he's darn good at economic numbers. The former Federal Reserve Board of Governors, the University of Chicago economics professor. I wish I had more professors like Randall when I was in school, but I didn't. And this is what you got, America. But anyway, Randall, so good to have you. You know what was interesting, Randall, about the Starbucks story is that people will willingly pay the higher prices. They might not flip over it. Obviously, a lot of people have a coffee fix. I get it. But I'm seeing that in a lot of industries. Not everyone, but you know, there's a price people are willing to pay, and as much as that price goes up when it comes to Starbucks coffee and a lot of other items, including ticket prices on planes and hotel bookings and the like, they'll pay that. What do you make of it?
Yeah, I think there's much more tolerance for prices, for higher prices, and of course, costs are going up a lot for, you know, whether it's at Starbucks, they've got to pay a lot more for those baristas than from before, and so you're getting costs going up, prices going up, and the concern is that people just get so used to it that prices continue to go up.
What I worry about, Randall, you follow this data far more closely than I, but that some companies take advantage of that. I don't want to sound jaded or cynical or like, you know, Alexander Ocasio-Cortez, but I wonder whether some use a window or an opportunity like this to also raise prices and say, gee, we had no choice. What do you think?
Well, we certainly see costs going up all over the map, and so labor costs, input costs. So there's a just to cover their costs, prices are going to go up, and certainly there may be some companies that will try to push things a little bit further. If there's not a lot of competition, they'll be able to keep it up. If there's a lot of competition, they won't be able to push it too far.
So the Federal Reserve indicating that it raised interest rates again and apparently really troubled the markets by hinting that this doesn't end anytime soon. Maybe the rate of increase might not be as dramatic next month, but the increases are still on. Are they? And how far do you think this goes?
So I think the markets are finally taking them seriously. They said they're going to keep at it until inflation really starts to come down in a convincing way. But
they want to bring it down. They want to bring it down to 2%. I mean, if that's their goal, I mean, we're not there by a long shot.
No, we're not there by a long shot. And Jay Powell, the chairman of the Fed, underscored that and said, you know, we've still got a long way to go in raising rates. I think there's a lot of hope that they would just stop, but inflation is still there. We're still seeing wages rising, prices rising, and it's really important that the Fed keeps inflation under control and tries to bring it back down. And so that's why they're going to continue to raise rates. Probably another 50 basis points, maybe 75 in the next meeting next month, and they'll continue to raise it until rates, I'd say, are somewhere between 5 and 6% next year, and then they'll probably take a pause and see what the consequences are.
So we're at around 4% now. Another half-point hike, let's say, at a minimum next month. You get to around 4.5%. Another hike after that, you're around that 5, maybe 6%. But let me ask you about whether the Fed risks overdoing. And I know that's always something you worry about, and maybe on your days in the Federal Reserve. But we've seen little indication that inflation is coming down. Maybe the rate of increase isn't quite what it was, but it's still pretty serious. And that's after a quadrupling of rates from essentially zero. So how does the Fed know that this is working?
Yeah, that's the challenge, because as Milton Friedman famously said 70 years ago, and it still applies today, monetary policy has an impact with long and variable lags. And so obviously it has a quick impact on things like the bond market and the equity market, on interest rates and stock prices. But it takes a longer time to have an impact on things like housing and then on employment. And the thought is usually it's sort of 6 to 18 months is when the main impact comes. The Fed really only started tightening in March, so we're probably going to see the impact on the labor market either at the end of this year or the beginning of next year. And I do think the unemployment rate is going to start to go up. The challenge is that the Fed needed to move quickly to make sure they didn't allow inflation expectations to get out of control. But by moving so quickly, they haven't had time to see, well, what is really going to be the consequence for the economy? Have they gone too far? I think it was really important they needed to move to make sure not to lose that credibility. That's what happened in the late 1970s, early 1980s, the last time inflation was this high. And you have to remember, the Fed raised rates to double-digit levels. I don't think they're
Absolutely.
going to have to go there now. But if you could get a mortgage at 12%, you were happy to get that in those days. Today when I mention that, people just think that I'm crazy.
Oh,
but
I
that
know what
actually
you're
did
speaking
happen
about.
back.
Absolutely. My wife and I, our first mortgage, my staff gets tired of hearing this because they've heard it for 10,000 times. 13.5%, and we thought we were Nostradamus, Mr. and Mrs. Nostradamus. We were not, but that was the time. But Randall, fascinating. Always good seeing you. Thank you very much.
Bye-bye.
All right, Randall Kroszner.